Hello, I welcome you all to this free webinar, the first of our series. With your support and appreciation, I hope that there are many more such webinars to come. Today we are going to talk about trend lines and moving averages. Trend lines and moving averages are used to determine the trend of a stock. Now when we talk of trends, according to the Dow theory, which is the oldest and the easiest way of determining trends, the Dow theory said that when we have higher lows and higher highs, like in this phase over here, we are in an uptrend. And similarly, when we have got lower lows and lower highs, we are in a downtrend, like this phase over here. A trend is said to change in Dow theory when we have a lower high and then a lower low, or a lower low and then lower high. So in this case, we have a lower high here, we have got a lower low, a higher low over here, we've got a higher high over here. Now when the prices have come down below the previous low, we know that a lower low is about to happen, and then the prices go up again. They start coming down, and it is somewhere here that we realize that this high is lower than the previous high. And when the prices go below the previous low, which is at this point, we realize that okay, we are now in a downtrend, and by this time we have already lost about 30 to 35% of our portfolio. Now this is where trend lines come in handy. Now let's look at this chart over here. When we draw a trend line by connecting two or more consecutive lows, we get an uptrending trend line. So as soon as the prices go below the trend line, we say that we are now in a downtrend. Similarly, when we connect the two or more consecutive highs, and when the prices go above that trend line, we say that the downtrend is now finished and prices should go up from here now. Now similarly, if we connect these two lows, the moment the prices come down below this line, we will come back in a downtrend. Now a property of trend lines is that the prices tend to find support or resistance near the trend lines, and same happens with moving averages also. I prefer to call moving averages as moving trend lines. Now suppose if we add a moving average to this chart, say let's add a green colored 20-day moving average, and yeah, this looks like a good period. Now at this trend line, we can see that whenever the prices come close to the trend line, they find support near it. Similarly, in a downtrend, whenever the prices come close to the trend line, they find resistance near it. So a moving average provides both support as well as a resistance to the prices. Now another advantage of moving averages is that we get buy or sell signals from them. So the moment the prices go below the moving average, we get a sell signal, and the moment they go above the moving average, we get a buy signal. We get a buy signal over here, a sell signal over here. Now another important thing to look at moving averages is the direction of the moving average. Now the moving average here is going upwards, and it has now slowly changed its direction downwards. So when it changes its direction downwards, we get an indication that the trend is likely to change or reverse. Similarly, the moving average was coming down over here, and they slowly changed the direction to upwards. We get an indication here that okay, the trend is probably likely to reverse and the prices should go up from here. Then we get some signals from multiple moving averages also. Now if we add a 10-day moving average also to this chart, say brown in color, we get something like this. So when the shorter term moving average penetrates the longer term moving average downwards, we get a signal to sell, and similarly when it crosses it upwards like here and here, we get a signal to buy. So we get very good signals from moving averages if the prices follow a particular trend, but moving averages are not very good when there are not very volatile movements, when the prices are hovering around the same levels. For example, the current here, okay, this may not be a very bad example, but it happens sometimes that we get a lot of whipsaws, like over here. Moving averages are very close to each other, no proper direction in place. We get some more signals from multiple moving averages. Now if we add the 5-day moving average also to this chart, say, which is black in color, we already have the 10-day and the 20-day moving average. Let's add a 50-day moving average too, say this dark green color. Let's add a 100-day moving average, say, which could be dark teal, and a 200-day moving average, which could be blue. So we have got 6 moving averages over here. Now let's look at what happened in the past. Okay, let's start from here. Now here we can see all the moving averages are very close to each other. This was in June 2004 probably. Sorry, June 2003. All the moving averages were very close to each other. We get a signal that the prices should break out from here. We should get a very big move from here, and there we did get a big move. We go further in the chart, we find that this happened again in August of 2004. August of 2004, all moving averages were very close to each other, and we saw a very big move that time again. The same thing happened in May of 2005. We again get a very big up move. It happened in July, August of 2006. A big up move from there too. In March, April of 2007, a big move from there. In August, September of 2007, a big move from there. And now again the same thing is happening. All the moving averages are converging together. So we are probably going to get a very big move from here. Let's see the data window. We can see that the moving averages are all between 4906 and 5110. So that's hardly a range of 200 points, and when the range of Nifty itself, the average range of Nifty itself is about 100 points a day, 200 points is nothing. So we are probably going to get a very big move from over here. Now which direction will that move come in? That is not sure from the charts, and to see that we'll have to see some other indicators. Now if we look at the trend line, we can see that the prices have gone through the trend line, so we are probably looking at higher prices from this level. The prices were moving in a narrow range within this rectangle. They have broken out from here, so again we are looking at higher prices. The 20-day moving average, which is a good indication, the prices have gone up from there also, above the 20-day moving average. So we are probably looking at higher prices. Let's look at the RSI. Okay, the RSI too, it has broken its downtrending trend line. The RSI has now gone above 60, and probably we should be looking at higher prices from here. So that's all about moving averages and trend lines today. I hope we have more in our next webinar, and if you enjoyed today's webinar, please leave your comments below this post, and probably we can have some more webinars in the weeks to come.